All right. So for those who may not be familiar with who I am, if this is your first experience joining us for these webinar series, my name is Marcus Rather. I'm a financial advisor of Cetera Investors, independently managing my practice. And I'm now located in Charlotte, North Carolina. Previously was in Richmond, Virginia, where our office was located in Glen Allen, Virginia. But now I am located in Charlotte, North Carolina. Of course, I am licensed in various different states. So here to meet whatever needs that you have. Again, today we're going to be going through a conversation about life insurance, and there are four key themes that we'll be discussing today, really centered around why should anyone have life insurance. I do have a few poll questions that I'd like to ask everyone, just as an interactive activity. So the first question I would like to ask, and feel free to answer, this one is multiple selections, so hopefully on the screen you can see. But the first question that we'll be asking is, are you confident that you have enough coverage? It's a yes or no question there, but feel free to submit those answers. Are you confident that you have enough coverage? And just another few seconds. All right. And then I'm going to bring up another poll. Now, for you and your individual situation, your individual plan, what would you say is the purpose of your life insurance protection? Again, this is a multiple choice selection, so you don't have to only choose one. Feel free to choose as many as you would like. But what is the purpose of your life insurance? Do you use your life insurance, or do you have your life insurance for protection, i.e. the replacement of income? Do you have your life insurance as a means of having supplemental retirement income and a way of accumulating wealth through utilizing cash value? Are you mostly using your life insurance as a means of providing or leaving a legacy or a way of transferring wealth, whether it's personally or for business? Or are you also using your life insurance as a means of having long-term care resources as well? So feel free to choose as many of the options that you like. All right, I'm going to end that poll. And we might as well finish off with the last poll question. This is a two-question poll here. So there's two questions. One is, when's the last time that you've had a conversation with your family, your friends, or if you're a business owner, if you're a key employee, about the legacy that you plan to leave? And if you joined us last month in person for our 6 steps to legacy planning for the generations, hopefully you see the difference between legacy and estate. So legacy is oftentimes an intangible and tangible means of leaving something. So it's not just financially, but your intrinsic values, your core beliefs, and your previous knowledge. So that's question one. Question two is, when's the last time that you reviewed the details of your insurance policy? If that was within this year in 2025, if that's within the past year being 2024, it was a few years ago. If you're not sure that you've done it, would love to see what your answers are there. And we're going to end the polling there. So throughout our conversation, I'll be sure to double back and share the results of that poll. But to start things off, we're going to be talking about the first piece of why anyone should buy life insurance. And the natural design of life insurance in itself is for protection. Now, there are many uses, as I said before, of how you can have life insurance positioned within your holistic financial plan. And there isn't just one exclusive use for life insurance. Honestly, you can have many different policies. You can have one policy and you can use them for many different things: protection, income planning in retirement, or maybe even pre-retirement, legacy or wealth transfer, and then long-term care funds for any assisted living or things along those lines. So starting off with protection, right? That's the biggest number one reason I would suggest anyone to have life insurance is for protection, right? Now, what are we protecting? I see protection as, I'll say, two typical needs of protection. One is either a replacement of the loss of income. So should someone pass away either early in their profession, midway through their profession, or even in retirement, there's going to be some type of loss of income. So if it's your working income while you're working, whether you're employed or self-employed, business owner, whatever the case may be, when you're no longer here, chances are there's no further income that will be earned by you. If it happens in retirement, for those who may be transitioning into retirement, maybe you're living in retirement, when you pass away, you may see a stop of one Social Security check in the household, and then you may have a loss of a pension depending on the selection that you made when you retired with your pension. So income replacement will be one major need as far as protection. But then there are cash needs. And some of those bullets can be summarized by what I would define as a cash need. So paying off debt, right? A lump sum payment to pay off things like a mortgage, like any personal loans, private student loans, credit cards that may have been co-signed, anything that may be passed on to a surviving person. We want to leave cash to pay off any remaining debt. Any future expenses, such as funeral costs, the cost to have a celebration of life, the cost of transferring a body to and from one place to another, or just burial costs or anything along those lines. Cash to provide dreams, right? We talk about young families that are growing and have children that are going from high school to college. Well, if they're no longer here to pay for education and maybe there's not adequate savings set aside, that's cash that can be provided for your children to further their education, whether it's 4 years of undergrad, grad school, trade school, whatever the case may be. There's cash that would need to be provided for dreams such as education. And then for businesses, business owners, if you find yourself as a key employee, what type of impact will it have on the business if you or that key person is no longer there to run or operate the business? So business owners, if you're partners and you have a partner that passes away, you may want to consider life insurance as a means of having what I call a buy-sell agreement, a way to provide resources to maintain ownership of the business from one family to another, or key employee, or what you see business buyout would be the buy-sell. But business expenses would be something like a key employee type of policy, or the purpose of the policy is to protect the key employee, because when that employee is no longer there, you may have an impact on your operation. It may take some time to find, adequate labor and skilled services to replace that person. And as a result, again, you may see a change in your revenue from the operation. So there are a lot of different things that fall under protection, and it can be categorized as two things, as I said before. One will be the replacement of income, whether it's current income, future income, pension, Social Security, retirement income. And then two would be cash, right? Cash needs for paying off debt, providing future expenses, leaving some type of cash for future dreams, and then operation of the business. Now, I will pause this and switch my share because I do want to provide an additional resource of how an individual, how a business owner, how a company, how a family can identify how much they actually need to have in coverage, which is why I addressed one of the questions, how confident are you that you have the right amount? So this website is available, no charge, no fee, and no, you don't have to type in your email to get spammed to get the results. This website is lifehappens.org, lifehappens.org. And prayerfully, I'm sharing the right screen, so I'm going to just double check and make sure I'm sharing the right screen. But through lifehappens.org, you see you have a lot of these tabs at the top. I will be honest, the tab that I use the most is calculators. A brief, quick walkthrough, I'll start off with human life value. This is, I believe, one of the most easy ways of identifying how much someone should have in life insurance protection. because it identifies your total human life value. And as you'll see, is really predicated on the income earned. So just to use round numbers, let's assume the annual income earned is 100,000. That person's top tax bracket, single, would be 22% federally, and state may be a few percentage additional. Savings, let's just put 10,000. Years until retirement, let's just say 25 for anybody that may be young. And then we can also go back and say 5 years to retirement. Current life insurance, let's say they have 2 times their salary through work, which is oftentimes standard for any employer benefit. And then other assets, let's say they have saved 100,000 so far in the 401k or in investments and other assets. Now, when we look at the human life value, right, they have 25 years of earning that $100,000 salary. If that's indexed or adjusted for inflation, this is basically the total earnings that they would have approximately right before they transition into retirement. So for someone who has a longer time period of work, their human life value approximately be about 3.1 million. Now, if we look at the total resources that they have, well, if this top number is what they're worth from a value perspective, if this is all of the income that they would earn over their professional career, this is what we have to replace it, right? Right now, it's only 2 times their basic salary through work, 100,000 in retirement investments or other investments, 10,000 in savings. So you can see from a human life value standpoint, there's a large amount of life insurance that's needed. Now we can start over just for kicks and giggles here, and let's shorten that time frame. Let's say 100,000 is still the same, and let's say give it 10 years until retirement. And all things considered the same: 200,000 in life insurance, 100,000 in other assets, and 10,000 in savings. What is their human life value? They still have a human life value of 910,000, and then the total resources that they have are 300. So you see, you still have somewhat of a life insurance need. Now, oftentimes, the reaction that I get when we go through that conversation is, man, that's a pretty large number, right? It's hard to believe that my life may be valued at 3.1 and that I may need 200 or 2.6 million in additional coverage. That seems like way too much. So when that reaction happens, I oftentimes have a conversation, well, if this is what you're valued at, and if this is what we say we need, how much do you actually want? So the question is, how much should we have based on what I want to provide if I were no longer here? And you see the same question starts: how much annual income would I like to provide if I were no longer here? So assuming I'm making 100,000 before taxes, I don't get to see all 100,000. And if I'm married, then maybe they don't need all of my income, but they need about half. So let's say I want to provide 50,000 in my income, and I want to provide that for how many years? Let's say 12 to 15 years should be enough to adjust to me no longer being here, family growing, so on and so forth. How much debt would I like to pay off? Let's say I have a mortgage and anything else. Let's just round it up 300,000. And if I happen to have any child care, which I don't, and how many children would I require funding for if I did have a child? Let's say I do want to provide public school education, and my child currently is 3 years old. They're going to go to a public school, and I currently live in North Carolina, which I'm so used to picking Virginia. And how much would I like to set aside for any additional cash or emergency? Let's just pick a number and say 20,000. How much personal life insurance do I have? Let's say I still have 2 times my salary, which typically you would not want to include any group term that you have. So really, we should say 0 for this example. Now, human life value said I'm worth 3.1. Current assets, I have about 300,000. But in terms of outside coverage that's not included in work, I would say 0. Well, this is what I would need. So we came from 3.1 value, 2.6 need, which is, what I need less what I already currently have in total assets. But what I want to provide is about 1.1 million for my family. So that's just a brief, hopefully brief exercise of how someone can identify how much they need to have for the purpose of protection. So I'll pause there and see if there are any questions that anyone would have from that perspective of life insurance. Any Q&A, any questions, any comments? All right, none coming in yet, so I'll just continue going on. Now, ways to set that up. So now that we know what I want to provide, now that I know how much I need, what's a good way of providing that amount of coverage to make sure that I have exactly what I want to have? So typically, you will want to set up, you want to buy the highest death benefit with the least premium, right? Especially if you're young professional or, even let's say middle age and you're still focusing on saving for other goals like retirement. Maybe your children are past college, but you still have a large need. Your focus is protection. You typically want to find the most affordable that can still allow you to save in other areas. So common ways to structure the protection could be, one, you could do exclusively all of it in term. For those who may not be familiar with what term life insurance is, term is a temporary lasting type of life insurance policy. So terms come in variation based on either years or an age. So the policy will last either 10, 15, 20, 25, or I've seen 30 or some cases 40 years, for which your premium is level during that time. Should you outlive that coverage, should you outlive that duration, then your options are to either renew the policy or purchase a new policy based on your age and your health at that time. So term does provide the most death benefit for the least amount of premium, but it is not the end-all, be-all solution for life insurance. You can also consider universal life with a return of premium at specified years. So instead of it being temporary by term, you can structure it to be temporary by using what's called a universal life policy, or you can do universal life or whole life with cash growth to protect for more years. So again, these are different options that you can consider if your main purpose of life insurance is protection. And I'll also say there's no one-stop solution. You can have many different policies. You can have a term and a permanent to meet those needs. Now, point number two, if you're using life insurance as a means of having income later in life, I'll say specifically for retirement, but the good advantage of life insurance is that this is an asset that, depending on how it's structured, depending on how you fund it, this may be cash that you can access before traditional retirement at 65 or 67. And actually, you can actually access the cash value prior to 59 and a half. So this is a long-term plan, right? The life insurance is still life insurance, but the purpose, the strategy, the use of the policy is to be used as a long-term plan. And you're funding life insurance at some future time, 10 plus years. And the plan is to take distributions from the cash value of the policy. So one of the key features of the strategy is to structure the distributions so that they're all income tax free. Now, what type of policies can provide me that avenue of accumulating cash value, and I can access it before 59 and a half, before 65 or 67, or maybe those are my time frames as to when I want to access those. So common policies that you want to look at will be the permanent type of life insurance policies. Now, you'll see I say permanent type because there are three or multiple different types. I'll say three main categories. One will be a traditional whole life policy. Traditional whole life is very vanilla, if you will. It's very straightforward. It's very simple. There's not a lot of extra bells and whistles. With whole life, you pay a fixed premium. The death benefit is typically level, meaning the death benefit stays the same, and your cash value is a contractually guaranteed value that you know will happen every single year. So you pay the same amount, the death benefit stays the same amount, and your cash value is a contractual guarantee. Now, most people who like funding life insurance as an asset, as an investment vehicle, like to have better opportunities for growth. And as I said before, whole life is very vanilla, it's very straightforward. So what they've done is they created more of a hybrid solution where your cash value can grow based on the performance of a underlying index, i.e. index universal life, or it can grow variably based on the performance of sub-accounts. Very similar to like investing in mutual funds in a retirement plan or commonly ETFs in today's time. These are called sub-accounts, and they're appropriate within the variable universal life chassis of life insurance. So these are three different types of policies that you can consider when you're using or planning to have life insurance as an asset for income later in life. Now, how the policy is structured, one thing I don't want to go too far off the rails in explaining is the tax treatment or the tax strategies that go into life insurance. There is one thing you do want to know. You do want to be sure that if you're overfunding or if you're really paying a lot of money investing in a policy, you want to be familiar what's considered a modified endowment contract. So a modified endowment contract is a tax qualification of a life insurance policy whose funding exceeds the federal tax law limit. Now, these are not the same limits that you would have on a 401k contribution per year or an IRA contribution per year. These limits are in determination in accordance with the death benefit. So it's not an annual federal regulation of how much you can put in. It's really determined or calculated by the amount of death benefit you have in the life insurance policy. So you do want to be aware within the individual policy of how much you can be funding either one time, over 7 years, or over the life of the policy to avoid that life insurance policy becoming a modified endowment contract that could actually lose some of the tax advantages that are typically built into a life insurance policy. So how does that look in actuality? Well, on the left-hand side, you see the traditional design for a life insurance policy is to have the maximum death benefit and you pay the minimum premium. So believe it or not, insurance companies don't just want you to get, they don't want to get all of your money. The traditional design for life insurance policies is that you pay the minimum amount that's required and you get the maximum amount of death benefit. Now, if you're using this for income, clearly we want to overfund the premium so we can help accumulate the cash value. So on an enhanced design, we're really targeting a minimum death benefit and we're looking to pay a maximum premium. Someone would say a modified endowment contract can inversely be seen as a maximum efficiency contract. Modified endowment contract would say, well, if you pay over $25,000 a year in premium, this is going to become a modified endowment contract. Well, they basically said the maximum amount that you can put in is $25,000. So it's now a maximum efficiency contract. I know I could put in this amount, max it out, and help accumulate some cash value. So by chart, let's assume we have a business owner, a highly compensated employee, self-employed person, male, age 45, preferred non-tobacco rating. So one thing about life insurance, you do have to be healthy enough to get the policy. So in this case scenario, preferred non-tobacco, and the initial death benefit is $500,505. Now, this is very specific for the death benefit because the target annual premium that we want to pay is $20,000 per year. Now, the emphasis, again, some people will say, well, who the heck will pay that much for life insurance? Typically, for people that make a certain amount and that have already maxed out contributions towards retirement accounts, if you're looking for other avenues to invest money, and remember, do it on a tax advantage way, life insurance provides that tax benefit because when you pay a premium, that's seen as your basis. And the cash value that grows in a life insurance policy can be accessed in a tax advantage way as long as it's not a modified endowment contract. The way that you can access cash value on a tax-free basis would be either through the form of a loan against the cash value or maybe a partial surrender or full surrender in which as long as you get back less than what you paid into the policy, then the money will be fully tax-free. If you surrender your policy and the cash value is more than the premiums that you paid, that is seen as a gain, at which point you will have taxes on the gain versus taxes on the full amount of cash value. So in this hypothetical scenario, we have a policy owner paying $20,000 per year in annual premium. We're really overfunding this policy, so there's more cash value that's accumulated starting in year one, and we're funding this until he turns 65. So you can see from 45 to 65, he's paid and invested $400,000 into the policy, and at 65, this cash value is now worth $667,000. Now, you may notice this is not the same as investing or saving $400,000 net. Because we're still paying into a policy, we're still paying premiums, so the dollars are not net dollar for dollar invested in the market, in the sub account, whatever the case may be. Now, the way we structure the payout, so these 65 policies paid up, $667,000 in cash value. The death benefit as a result of the growth of the cash value has grown to $1.1 million. So the way that we can structure his withdrawals are in the mix of either loans or withdrawals to the net premium and then loans from thereafter. So he is able now to withdraw $53,000 a year in income, tax-free, tax advantage, while still having a reasonable amount of life insurance as a death benefit. So from a mathematical, numerical scenario, or just to show the data for those that are very inquisitive, when you look at the net cash value and the net death benefit, starting at age 45 all the way to 65, you see the net cash value growth gradually increases and the net death benefit also increases. But then you see the inverse, the withdrawal percentages start to grow, but the death benefit starts to decrease because of the amount that's being withdrawn in retirement. So on the third bullet point, so we talked about income. If you have any questions, please, again, feel free to put those questions in the Q&A box. But as I wait for those questions, just to continue on, we'll talk about the use of life insurance for legacy transfer / wealth transfer. So life insurance is one of the few vehicles, probably the most efficient vehicle in terms of leaving a financial legacy or doing wealth transfer. And I say that answer, in my professional opinion, is because of the tax-free death benefit that's paid out and because of the leverage of the premiums that you pay versus the amount that's paid out to your beneficiary. So when using life insurance to provide a legacy for another person or entity, the life insurance is often creating wealth versus simply transferring wealth. So going back actually to that example, if I could, to show the creation of wealth opposed to the transfer, in this scenario, if we looked at this just as purely as a protection play, you can see from 45 to 65, although he paid $20,000 a year in premium, a total of $400,000 into the policy, the death benefit is $1.191 million tax-free to his family. Now, we could simply run numbers and say, well, if I invest $20,000 and put that in the market, put that into anything, right? And I get a better rate of return, or say that 400,000 grew like this policy into 1.1. Generally, where that money is being invested are typically either in pre-tax accounts like 401k, 403b, thrift savings plan, traditional IRAs. So that money then will be taxable to your family, to your beneficiary, whomever they may be. With life insurance, again, it's not just the leverage on the dollars, because we're, again, creating a larger death benefit versus what was saved and or invested, but we're doing so in a very tax efficient way. So when we talk about legacy, if you joined us last month when we were talking about those 6 steps to legacy planning, you would have learned that there's a difference between simply estate planning, which can be mundane, which can be very morbid, which can be very daunting. Legacy planning incorporates some family values, it incorporates life lessons, it incorporates learnings that you've had, family photos, family recipes. It mixes intangible and personal values to financial value. So when you think about legacy, you want to consider one, what are those intangible values? Two, you want to figure out how to best leverage your resources, similar to what was illustrated. You want to consider how to preserve your pension for the next generation. So if you're analyzing, which we'll go over in a few slides, whether taking a single life pension versus a survivor benefit for your pension, in some cases, it actually looks a lot more attractive to fund your pension protection through life insurance versus through the pension plan. You also want to know how to have your beneficiaries treated fairly, and more importantly, how to avoid that ugly, daunting, draining probate process. So ways that you can avoid the probate process can be as simple as one, identifying beneficiaries or designating beneficiaries on all of your assets. Those assets could be simple as checking and savings accounts at the bank. They could be investment or brokerage accounts that you may have with a financial institution. It could be retirement accounts, retirement plans, pension plans, life insurance policies. And depending on the state in which you live, you can also have your personal property with a transfer of deed designation. I know Virginia definitely has a transfer of deed within the state. So you want to be sure that you're properly identifying and designating beneficiaries on whatever tangible assets or accounts can be passed on. You also want to consider gifting while you're alive, right? Maybe it's a better strategy to start to gift those items, those things, those accounts to those important people, to those charities, to those organizations. But you always want to keep in mind taxes. With every transaction, with every decision, generally there's Uncle Sam looking to get his fair share. So we're not CPAs, right? I'm not a CPA. I'm not a tax advisor. I am privy to a lot of the tax nuances that go into financial planning. But I encourage everyone to make sure that you partner with a tax professional and allow me the privilege of working with you and your tax professional to identify the most tax efficient way of creating the legacy, but also transferring that wealth. So what policies can you consider if your focus is legacy transfer or wealth transfer? Well, all these policies are just about the same as what you've heard before. Whole life, universal life, index universal life, variable universal life. Most of these options are permanent types of policies. The reason why we consider permanent policies opposed to term is because chances are these desires that you have to create the legacy, to transfer the legacy, are not temporary in nature, but they're typically long lasting. You absolutely, unequivocally want to provide this value to your beneficiary. So because that's a long lasting need, we want to have a long lasting policy. Hopefully, kind of catch how that goes. So you can consider a single premium simplified issued policy, which comes in variations of whole life, universal, or index universal. The thing there is you pay one single premium. So maybe you have money that you saved in the bank. Maybe you're taking large withdrawals from retirement accounts and you don't necessarily want to spend it and you may want to leverage it. You could do a single premium policy in which you pay one premium. Death benefit lasts forever until you die. You can consider a second to die or a survivor. So this policy pays out upon the death of the second person that's insured. Oftentimes we find these with spouse or couples, right? The first person passes away, there isn't a death benefit that's paid out. But when the surviving spouse passes, that's when the wealth is transferred and that's when the wealth is created. So you can consider a survivor whole life, survivor universal life, survivor index, or variable universal life. Again, the purpose or the strategy there is that when the second person, the second surviving spouse passes away, that's when the wealth and legacy is transferred. Or you can simply look at a fully underwritten policy. Again, the variations are all the same: whole life, universal, universal, index universal, and variable universal. So going to that pension max example, for those who may be considering drawing a pension, we have my favorite aunt and uncle, Aunt Viv and Uncle Phil. excuse me if I say Aunt Viv because that's how Fresh Prince said it. But Aunt Viv and Uncle Phil, Aunt Viv is 66, Uncle Phil is 65. Aunt Viv had a pension that will start at the age of 66, and she has two options to structure her payout. She can either choose a joint life payout for $4,300 a month before taxes, or she can choose the single life option for $5,500 a month and have that as long as she lives. So she could choose a single life option of $5,500 and pay an extra $1,200 in a guaranteed no lapse life insurance policy, which would buy either $150,000 or $300,000 in coverage. So looking how the numbers play out, here are the risks with both of those options. I think the easiest risk to identify is a single life, and we never have a crystal ball, but chances are that women will outlive their male counterpart. But there's always a chance that she could pass away before Uncle Phil. So if she chooses a single life option and earns the $5,500 per month, and let's say she passes before Uncle Phil, well, that leaves Uncle Phil, again, with that loss of income. So it's very natural for her to consider, hey, I absolutely want to leave Uncle Phil or my husband Phil money from what I've worked to earn because he needs that money. I want to make sure he has a sustainable lifestyle in retirement. So that will cost me $1,200 to pay to the pension plan. Now, you may be asking, what's the risk in taking a joint life? Because it seems pretty straightforward. If I die, Uncle Phil gets my benefit, everything works out. The risk is that Uncle Phil may pass before Aunt Viv. And should he pass before Aunt Viv, now that leaves Aunt Viv to choose, well, if I paid $1,200 a month, or if I took $1,200 a month less in my benefit to make sure that Uncle Phil had this income, but Uncle Phil's no longer here, well, in some cases, I may never get that $1,200 back, right? I can't go back and go choose a higher benefit from that point on. Some pension plans offer it, right? I know state of Virginia retirement system, there are triggering events that allow a surviving person to choose to switch back to the basic, at which point the second risk of the joint is that all those years that she paid into the state plan to make sure that that pension can continue, she never gets that money back. Or the third risk is, well, maybe it is important that she still provides this to her children, Carlton, Ashley, Hillary. Don't know how I forgot that. But maybe the pension plan either doesn't allow it to go to children, or if she leaves it to the children, she takes a further reduction on the benefit. So all those risks being accounted for, this is where you can see where it can make sense to consider having their own individual life insurance policy as a means of providing that replacement of income. So if they're both living on a joint life, you see they earn $4,300 per month. If Aunt Viv outlives Uncle Phil, she'll continue to get the $4,300 a month, thus permanently sacrificing $5,500. And if Uncle Phil outlives Aunt Viv, well, the protection is in place, so Uncle Phil would then receive the $4,300 per month. Now, if she chose a single life with insurance, and let's say she chose 55, but decided to live off the 43, well, now she's paying $1,200 a month for life insurance, but this actually provides a larger benefit. Here we're saying 150, really it could be 300,000. If Aunt Viv continues to live and outlives Uncle Phil, what are her options with her own life insurance policy? Well, one, she can continue to get the $5,500 a month. If it's indexed for inflation, it might be a little bit higher. Number two, if she decides to keep the life insurance policy, she can always change the beneficiary. And again, with some pension plans, if you leave the beneficiary to somebody significantly younger, you may see an impact on the benefit that you receive every month. The great thing with life insurance is that you, as long as you have revocable beneficiaries, you can change your beneficiaries however often and without any added cost or expense. So her cost for her life insurance policy is level, and there's no cost to her in changing the beneficiary to her children or maybe to some other organization or somebody else. Or she could choose to surrender the policy. And let's say she surrenders the policy and there's actually cash value that's returned. So there is a little bit of a return that she gets from the surrender. Now, if she passes away and Uncle Phil outlives her, well, no, Uncle Phil no longer receives the $55 or the $4,300 per month, but he would theoretically inherit the cash from the death benefit, which at that point would be completely tax-free. And if that death benefit is $300,000, then we provided a lot more tax-free money than what he would be getting taxable every month. So one thing that we did not address in this presentation was how life insurance can play a role in long-term care. And the reason we didn't is because I want you to come back and join me next month as we talk about ways of planning for long-term care. I have a guest speaker that will be joining us in October that will be highlighting how life insurance specifically can be used as a resource for long-term care. And then I will also be addressing ways how you can plan for long-term care as well. So without further ado, I do thank you for joining this experience. If you do have any final questions, any comments, please submit those in the Q&A. And for those that need to depart, I thank you for your time, and I look forward to speaking with you in the near future.